Welcome back, everyone. I hope you enjoyed lunch. Our keynote address today will be given by Federal Reserve Governor and Vice Chair for Supervision, Randall Quarles. Vice Chair Quarles was sworn in as governor on October 13th, 2017, and began his current 4-year term as Vice Chair for Supervision on the same day. In December 2018, he became chair of the Global Financial Stability Board. Prior to his appointment to the board, Vice Chair Quarles was founder and managing director of the Sinmore Group, a Utah-based investment firm. Vice Chair Quarles joined the Treasury Department under President George W. Bush from April 2002 to November 2006, and served as Undersecretary of the Treasury for Domestic Finance, Assistant Secretary of the Treasury for International Affairs, and Policy Chair of the Committee on Foreign Investment in the United States. He also served from August 2001 to April 2002 as the U.S. Executive Director of the International Monetary Fund. Without further ado, please give a warm welcome to Vice Chair Quarles.
Thank you. Thanks everyone for being here. Thanks for coming back from lunch. Thanks to Lisa and to everyone who's contributed to the conference. I think the morning, from my point of view, has gone excellently. I hope you've been getting as much out of it as we have been. This gathering comes just a couple of weeks after the announcement of this year's stress tests. So let me begin by recounting the highlights of those results, at least as I see them. They show that our financial system remains resilient, that capital planning by banks continues to improve. The largest and most complex banks were tested against a severe hypothetical recession and retained strong capital levels, well above their minimum requirements. They demonstrated the ability to withstand a severe and lasting economic downturn and still be able to lend to households and businesses. And additionally, virtually all firms are now meeting the high expectations that we've set to make sure capital planning takes into account their specific risks and vulnerabilities. That's an improvement from last year, and overall, these results are good news and confirm that our financial system is significantly stronger than before the crisis, and not just before the crisis, Tim, stronger, frankly, than the system has been in our lifetimes. Now, let me turn to the purpose of this conference, which is to sharpen our understanding of the experience gained from stress testing over the course of the last decade, and to apply those lessons to think about the future. And let me begin by acknowledging that notwithstanding our openness to learning from the collective experience of all of us in this room, the future of stress testing will, in a number of important ways, necessarily resemble the past. For example, we're still going to have them. Over the course of the last 18 months, I've heard overwhelmingly from academics, from think tanks of every stripe, from banks of every size, from regulatory colleagues, both domestic and foreign, that stress tests should continue to be a key element of the Federal Reserve's supervision of systemically important banks and a key aspect of the Fed's efforts to promote financial stability. Stress tests should continue to be regular, rigorous, and dynamic. And the bank's performance on those tests will continue to be the most risk-sensitive and consequential assessment of the affected bank's capital requirements. Transparency around stress testing process and results was a fundamental principle of the first stress tests and of every one that's followed, and it will remain a primary goal. Stress tests, as ever, will provide the public with essential information to assess the health of banks and of the financial system. And to be credible, stress tests will also continue to provide significant information about how the Fed does its work, so the public can understand the rigor and independence of our assessment process and how we come to form our judgment of the firms we test. Fidelity to these principles, embraced in the depths of the crisis by that first stress test a decade ago, does not mean that stress testing should never change, or that it hasn't changed over the years. We've learned from our experiences with the early tests and already added useful features and adjustments. These include a counterparty default scenario, as well as a number of policy statements that more explicitly convey the principles we find important in a sensible stress testing regime. Stress testing has evolved and must continue to evolve to take on what we as supervisors learn from our work and what we can learn from others. Each year, we've refined the substance and the process of the stress tests, guided by our own experience and by critiques and suggestions from others, and this feedback comes from a variety of sources, including conferences such as this one. And I'm confident that the presentations today will provide insights that result in improvements in our stress tests. If stress tests are to continue to be relevant and effective, I strongly believe that they must continue to change. They must respond to changes in the economy, in the financial system, and in the risk management capabilities of firms. Evolutionary change has been a consistent principle of stress testing since the beginning, embraced by my predecessors at the Board of Governors and our supervisory staff, and reflected in each cycle of tests. Without such adjustments, regulators, banks, and the broader public cannot get a clear and dynamic view of the capital positions of the largest banks in an evolving system. Stress tests each year have upheld the principle of transparency around the capital adequacy of our largest banks. Stress test results should allow investors, counterparties, analysts, and markets to make more informed judgments about the condition of banks. Along with other regulatory measures, this transparency increases market discipline, and it subjects the Federal Reserve to greater outside scrutiny and analysis. Accountability is important not only for some of the reasons mentioned today that apply in a democracy, but also in this case because stress tests can only be effective when the public has confidence in the Fed's evaluation of the capital adequacy of banks. I completely agree with the statement made earlier that, in effect, stress tests are also a test of the Fed's supervision of large banks. So, in these remarks, I'll first sketch out how changes in regulation, risk management, the economy, and overall financial stability have prompted alterations to stress tests over the past decade. Some of the current debate around stress testing seems to suggest that stress testing sprang full-blown from the forehead of Zeus in 2009, and we are only now proposing changes to it. But the fact is that it has been in a process of continuous evolution, and much of that evolutionary change has enhanced transparency, which was a founding principle of the stress tests. I'll then suggest some ways in which the effectiveness of stress testing can be further enhanced with greater transparency. 10 years ago, in May of 2009, the Fed and the Treasury Department released the first stress test results under the Supervisory Capital Assessment Program, or SCAP. At that moment, the U.S. economy was in free fall. The United States had lost an astonishing 3 million jobs in the previous 4 months. One significant reason for those losses was that many businesses were severely constrained in their access to funding and found it impossible to predict when that access might improve. The goal of the first stress test was urgent and simple: to restore confidence in the 19 large banks that then accounted for 2/3 of the assets in the banking system. In fact, simply announcing in March that there would be tests helped stabilize bank finances. That improvement continued after the results in May outlined the quite feasible steps for raising additional capital that banks would need to take, and did take, to be able to continue lending if adverse conditions continued. Challenging conditions did continue, but the stress tests and other actions taken in the first half of 2009 marked a turning point. The recovery from the Great Recession began in July of that year, as the financial system came back to life and then steadily strengthened. The principles that made that first test so effective were independence and transparency. For the first time, an independent authority, the Federal Reserve, would seek to independently assess risks. Just as important, the details of that assessment would be shared with the public, an extent of transparency that until then wasn't characteristic of bank supervision, but would become the hallmark of the regulatory framework erected in response to the crisis. The first test, as you all know, relied heavily on banks' internal risk models, but they still represented a huge step in independence in providing the public with an assessment of the health and resiliency of large banks. Transparency facilitated both market discipline and accountability. The information provided to the public under the SCAP stress test reinforced the entire enterprise of estimating the capital shortfall faced by major banks. It held the banks accountable for information on their capital adequacy and required them to fill the capital hole. The next big step in the evolution of stress testing came with its integration with the Federal Reserve's comprehensive capital analysis and review, beginning in 2011. One big change from the initial SCAP test was that stress tests were no longer a one-time emergency measure intended to restore confidence in major financial institutions. Instead, they became a recurring, ongoing process intended to maintain confidence in major institutions. Second, stress tests were no longer a discretionary exercise by supervisors. Under Dodd-Frank, they became the law of the land. And third, when they were integrated into CCAR, stress tests became part of a comprehensive, that's the first C, framework for capital planning that more closely connected capital regulation to risk management of banks and overall supervision. These were changes, but with the effect of reinforcing the founding principles of the SCAP test. Transparency was enhanced when stress tests became mandatory, recurring events, and the public could depend on continuing to have access to information about banks' capital adequacy. Also, the independence of those judgments was enhanced when Congress made them a statutory responsibility for the Fed and when they were integrated into our CCAR framework. Further changes to stress testing over the years have likewise reinforced the original goals. Stress testing scenarios have become richer and more challenging, providing more information about how banks would deal with a range of adverse developments, and, for example, exploring the effects of more differentiated risks that are not tied to the business cycle. Large trading banks now face an instantaneous shock to their trading assets, and many participants in the stress test now must address how they would respond to the failure of their largest counterparty. Our stress tests demonstrate that banks have now built enough capital to withstand a severe recession. The capital building phase of the post-crisis era is now complete. But as part of CCAR, stress testing continues to contribute to the significant and ongoing improvement since 2009 in risk management by banks. The original reason for the qualitative objection aspect of stress testing was to provide incentives for banks to address the risk management shortcomings that the Fed had observed during the financial crisis. For example, many firms that we supervised had substantial deficiencies in their ability to measure, monitor, and manage their risks. These shortcomings made it difficult for banks to accurately report their risk exposures to the board, and consequently threatened to undermine the credibility of the stress tests, which were and remain dependent on data from the banks. Since the beginning of CCAR in 2011, large banks have significantly improved their risk management and capital planning processes, which is hardly surprising. It was indeed the objective of the exercise. The qualitative assessment conducted as part of the 2018 and 2019 CCAR cycles found that virtually all firms meet, or are certainly very close to meeting, the Federal Reserve's supervisory expectations for capital planning. Large banks have improved the methods they use to identify their unique risks. They now use sound practices for identifying and addressing model weaknesses, and they have strong processes in place to evaluate their capital positions on a forward-looking basis. So while we continue to perform a qualitative assessment, of course, and ensure that that progress is retained, These improvements led the Fed to conclude that for most banks, this assessment can now be incorporated into our regular supervisory practices. The evolution of our qualitative assessment reflects the experience of the past 10 years of stress testing, and in particular, the great improvement in risk management by large banks and the cumulative effect of the Fed's improved supervision of large institutions. As I said earlier, for stress testing to remain effective, it must respond to changes in the economy, the financial system, and risk management capabilities. The changes to CCAR have occurred in the context of a similarly dramatic improvement in the strength and resilience of the financial system. The firms have more than doubled their capital since the first round of stress tests in 2009, and since that time, the common equity of the largest 18 firms has increased by more than $650 billion, well within the range that our estimates, and well above the range of estimates such as the Bank of England, of the minimum necessary capital in the system. Let me now turn to the most recent changes to CCAR and stress testing and put them in the context of the history I've just related. Congress revisited large bank supervision last year in S-2155, the so-called CRAPO bill, but the legislation it passed reaffirmed the important role of stress testing. That shouldn't be surprising, because the experience of stress testing over the last 10 years has demonstrated to nearly every participant that it is a highly useful element of large bank supervision and the promotion of financial stability. Something else that shouldn't be surprising is that this experience has revealed that periodic stress testing has turned out to be a less useful supervisory tool to evaluate the risks of smaller and less complex financial institutions. Congress made use of this experience by raising the threshold for stress testing to $100 billion in assets and providing more flexibility for the Fed to tailor stress testing for all firms. This step has, once again, advanced the principles demonstrated in the first stress test, and ever since. It has increased transparency because incorporating and disclosing what we've learned about the varying effectiveness of stress testing at different types of institutions is making stress testing more effective. The accountability of the Fed is enhanced when we are seen taking on board what we have learned through successive cycles of stress tests, and this strengthens both the credibility and the independence of our judgments. For those of us who believe stress testing should remain central to supervision and promoting financial stability, it's vital that an adjustment such as this takes place where it is appropriate. So with that in mind, let me review some recent changes and proposed changes to the Federal Reserve's stress testing practices. These changes are designed to make CCAR more transparent and simple and to feature less unnecessary volatility. The first principle is transparency. We've taken a number of recent steps to enhance the transparency around our models and the stress testing process more generally. Earlier this year, the board published enhanced disclosures on 2 of the key models that we use in stress testing. In addition, we published estimated loss rates for groups of loans with distinct characteristics to show how supervisory models treat specific assets under stress. We'll publish disclosures about 2 additional models in 2020 and each year thereafter until we've provided transparency about all of our stress testing models. And at the same time, we published a new policy statement on our approach to supervisory stress testing. Among other things, the statement emphasizes the importance of independence and stability to the credibility of our stress tests. We're currently considering options to provide additional transparency regarding scenarios and scenario design, and I expect that the board will seek comment on the advisability of and possible approaches to gathering the public's input on scenarios and salient risks facing the banking system each year. Such a proposal may also provide additional details about the scenario design features that underpins each year's scenarios and a range of other enhancements. Some argue that the greater transparency and disclosure promoted by recent changes and proposed changes to stress testing amounts to providing banks with the answers to the tests. This both overstates the extent of the disclosure involved and misunderstands what we're trying to accomplish in stress testing, goals that haven't changed since the spring of 2009. If the goal were only to conduct a test that was difficult to pass, like the qualifying exams for some of the more esoteric and restrictive high IQ societies, then trying to explain principles and scenario design and how models work would be inappropriate. If the measure of success for the Fed in administering a stress test was simply how many banks failed, then greater transparency would indeed be a mistake. But that is not the purpose of stress testing, and it never has been. The vitally important goal is to improve and sustain good risk management and capital planning at the individual institutions we supervise, and to promote the stability of the financial system. Like a teacher, or at any rate a good teacher, we want them to learn good risk management in the context of forward-looking capital planning. This will provide the public with more information about the capital planning of major banks and about how the Federal Reserve views good capital planning and risk management, bolstering our credibility. The second principle reflected in recent changes to stress testing is simplicity. One important proposal, what we're calling the stress capital buffer, would simplify the Fed's large bank capital rule by integrating the stress testing process with our traditional regulatory capital rules. Our regulatory capital rule includes both minimum capital requirements and a buffer that sits on top of those minimum requirements, and the buffer serves as an early warning to a firm and its supervisors, and it requires the firm to reduce its capital distributions as the firm moves through that buffer to approach its minimum requirements. Integrating these two standards is a natural evolution of CCAR away from its origins during the crisis, when such tailoring was impractical and policymakers hadn't yet considered the approach of a regulatory capital buffer on top of a regulatory capital minimum. The stress capital buffer would result in a more transparent and simplified system of regulatory capital requirements, because each firm will be held to a single integrated capital regime. It wouldn't reduce the stringency of the regulatory capital framework for large banks, but it would effect a substantial simplification of the framework. By my math, the number of different capital requirements applicable to large banks would fall from 18 to 8. I don't know that 8 is a magic number, but it's smaller. And the number of total different loss-absorbing capacity requirements for large banks would fall from 24 to 14. I expect that we'll move forward with revised stress capital buffer proposal in the near future, reflecting many of the comments received on our original proposal. The third principle addressed by recent changes is volatility. When I think about volatility in stress testing, I want to distinguish what I consider to be useful variation in the tests in the form of exploration of salient risks from what I consider to be less useful variation in the form of unexpected swings in capital requirements that don't have any particular relationship to the changing risks at individual firms. In addition, one source of volatility in the tests comes from the fact that banks are forced to do their capital planning before they get the results of our tests, and I'll address each of these concerns in turn. In distinguishing useful from less useful volatility, one option to address the year-over-year volatility of the test would be to average the results of the test from the previous year or X number of years. This wouldn't affect the overall stringency of the tests and would still allow us to have useful diversity in each year's test to explore different aspects of the responses of each bank's and the overall industry portfolio to different types of risks. But mathematically, it would mean that no single year could have an outsized influence on the amount of capital that a bank is required to maintain. The potential downsides to this approach include the reduced risk sensitivity that a bank may experience to a particular test, potential technical challenges associated with changes to a bank's balance sheet and earnings. But bearing in mind these potential challenges, I think that more thinking and discussion of this issue would be fruitful. With respect to the second concern, as I've said before, I believe it more rational and logical for firms to be able to plan for their capital needs with the benefit of the results of our tests. Given the huge strides that the banks have made in their capital planning and in meeting our expectations, I view the risks of banks backsliding in this regard to be minimal because it would be evident in the next test. Our capital planning expectations won't decline, and we'll continue to use the supervisory process to enforce those expectations. But it's my hope that greater transparency can play a role in other parts of our supervisory process. For example, by allowing other aspects of bank supervision to benefit from public input. Greater transparency for supervision is in keeping with one of the biggest improvements to the regulatory framework and to stress testing since the financial crisis. I believe the changes and proposed changes that are currently under consideration to stress testing and that I've discussed today reinforce the founding principles of that first test, administered in the challenging and uncertain spring of 2009, and reflect what we've learned each year over the decades since then. That process of learning and refining should and must continue in order to keep stress tests as relevant and effective as they have been in helping to reduce the chances of another severe crisis. So thank you all again for being here, and I'm looking forward to taking some questions.
So we are going to do the Q&As, but I'm going to start by asking Vice Chair Quarles a couple of really tough questions. And so I'll start by asking, you heard some of the discussion earlier today about some of the changes that we have made to date, and then you also kind of sketched out some of the additional changes that may be made. Some, I think, part of the public feels that we may be watering down our requirements. And do you have any response to that particular criticism?
So I think, so it's a very sensible concern on the part of people watching the evolution of the system to ensure that it does not result in a watering down. And I have no issue at all with public pressure being kept on to the Federal Reserve to prevent that from happening. I do think that when you look at the specifics of what we have proposed as regulatory changes with respect to stress testing or more broadly in the regulatory system, that they, that I think that a dispassionate examination of them would say, it's hard to say that that's watering anything down, given that we have been very careful about that. I don't think that they should be watered down. The issue with stress testing, for example, has not, in my view, has not been with its stringency, and so for that reason, the very first stress test that we administered after I arrived at the board was, I think, by everyone's measure, the toughest stress test that had ever been administered. One of the reasons for that was an interesting, although somewhat eccentric, assumption about the response of the slope of the yield curve in a position of stress. That's not something that we would continue to maintain. So this year we moved back to a more natural slope of the yield curve, and some of those changes moved that test, moved some aspects of the test back to what they had been more similarly to 2017, which had been the most difficult stress test up to that date. But other aspects of this year's test were more stringent even than last year. So again, I think that when you dispassionately look at what we're doing, we're not reducing the stringency of the test. And while I'm sure they'd like to, I actually don't hear many requests from the industry to reduce the stringency of the test. I'm sure that's strategic. But other things that we're doing, I think, actually improve our ability to run a good test. The transparency issue is not about allowing the banks to somehow game the system, because I think we put measures in place as to how we've done that prevent that from happening, whether you view compliance as gaming or not. I just don't think that's going to happen. It's about ensuring that we get more input from everyone in this room, which is not just the industry, as to what we're doing. And I think we've already begun to get some input on the increased transparency about models that we have that has not come just from the industry of, really, now that we see this, is that really what you meant to do? And, and the particular questions that have come in that I'm aware of, it is what we meant to do, but that's the sort of input that we ought to be getting and responding to.
The second question is about actually a paper which will be presented on the third panel, which will follow this particular keynote speech and Q&A. And it's a paper written by Nellie Lang and Don Cohn, talks about certain features of a current CCAR or stress testing regime where it has counter-cyclical features, and largely, I think in their paper, talks about how it was brought in by inclusion of the share repurchases and dividend in terms of just as thinking it through the countercyclical elements of the bindingness of the stress test. And obviously, you mentioned about the stress capital buffer, which that proposal includes elimination of the much of that pre-funded the share repurchases. And so arguably, they would bring down counter-cyclical kind of features of the current stress testing regime. So I know it's a long-winded kind of framing of the question, but I guess the question is, I mean, which is, I think is one of the questions I asked earlier in an opening, like can and should stress testing itself should be as counter-cyclical as what we attempted to do. If stress testing is not counter-cyclical, what are the other elements, if at all, should we consider for the counter-cyclical purposes?
So I think that's a very good question, and my own thinking on this has evolved over a shortish period of time. So I don't want to steal the thunder from the upcoming panel and presentation of the paper by discussing it before they've had a chance to make their case, as well as the other discussants. I mean, I hope that it's as much of a food fight as the first panels have been, because that's really been quite useful and interesting. I think there was, recognizing the limited number of countercyclical tools that the Federal Reserve has at its disposal. I think most central banks have a limited number of tools, but we have a more limited number of tools than some of what we would consider our peer institutions. There was a view, and certainly it was a view that I expressed when I first arrived at the board, and I think was a common institutional view, that, oh, but it's okay because the stress tests are our countercyclical measure, and precisely because of the almost automatic function of the lowering unemployment rate and other features of the macro shock, that's going to result in a tougher and tougher macro shock as the cycle moves. I think that over the course of the last two tests, we have been seeing the limitations of trying to use the stress test as our primary countercyclical tool, maybe even as a countercyclical tool at all. You know, that was a sensible thing to try to assume, but I don't think that it's been working, and I think we saw, again, with some of the, as we view this process perhaps continuing to exist for some period of time, you'd say, well, there's just a limit to how countercyclical we can make the stress test. So I'm not arguing that we should abandon the use of the stress test as a countercyclical tool, but I do think that it makes the potential consequence of changes to it that could reduce its countercyclicality less consequential, but it puts more of a premium on then what are we going to do with our other tools. You know, one of the obvious one is the countercyclical capital buffer, as to which there has been a lot of discussion. And there, well, I don't want to take up our entire time for questions on stress testing with that, so I might leave that for a separate time. But effectively, I think there are good reasons we haven't turned that on, but in part because given our where we have calibrated our through the cycle, both our through the cycle requirements as well as the density of our risk-weighted assets, given the stringency of our stress tests, I think we have effectively, relative to the rest of the world, turned on our countercyclical capital buffer. Which is why when you look at the risk to financial stability, which we regularly do every quarter at the board, and say, are there, you know, meaningfully above normal financial stability risks, you see areas of concern where, there is elevated risk to financial stability, but the overall risk to financial stability is swamped by the extremely low leverage in the financial sector that causes the overall view to be, well, this isn't meaningfully above normal. That's just another way of saying, although it took me a while to understand the implications of that repeated analysis, that this is another way of saying our countercyclical capital buffer is on. That creates issues for us if we want to turn it off at some point in the future, in a future downturn, because we don't have the ability to do that. So I do think that one of the things, at least that I am learning from seeing the limitations of the stress test as a countercyclical tool and becoming more skeptical of its ability to do that, is that we need to find some way to use the other tool that we have more as a way of being able to turn it on in a downturn, because I think the implication of our analysis is that we've effectively turned it on permanently.
Let me see if anyone has a questions in the audience. Right here in the front. Anyone with the microphone? Okay, I don't know where folks with mic. I think hopefully they're coming down.
I have one.
Me too. Yeah, there he is. Can you please announce your name and affiliation?
Yes, my name is Steve Marlin. I'm with InfoPro Digital, publisher of Risk Magazine. It was suggested in the first session this morning that the stress tests have caused banks to base their capital allocation decisions not on the fundamental economics of the business, but rather on how it would impact stress test results. And one possible solution would be to split the way the stress tests are run, so that the banks could use their own individual models to calculate their own capital requirements, with the Fed using its models for macroeconomic purposes. Have you considered, or can you envision considering such an option?
So that is something that conceptually, obviously, that I have, conceptually I've thought about. It's something that the Bank of England has a good model for, and we have talked over the years to understand more about how the Bank of England process runs. It's not something that is under, however, under active consideration at the Fed, for a couple of reasons. I do think that there is, one is, as I indicated in my remarks, I do think, the institution thinks, that one of the lessons of stress testing over the course of the last decade, one of the reasons for the higher confidence in the U.S. stress testing process relative to, again, some of our peer regulatory processes, has been that it is the Fed's view that we do have those separate models. I think that has been useful. Another reason, which sounds terribly mundane, but as all of you know, since many of you have sat in these chairs, when you sit in a chair like this, you have to take these things into account. Doing that is incredibly resource demanding on the supervisor. When we have talked to the Bank of England, for example, they said, well, we do this because we believe that it's intellectually superior, but we also do it to a handful of banks. We have no idea how it's enormously resource demanding on us, and so we have no idea how you would do it for the number of banks and the size and complexity of the banks that you would have to do it for, to actually review all of their different models and come to a view on all of their different models and interact in a way that was not excessively micromanaging with all of that. I mean, it becomes an exponentially greater logistical task as you increase the number of banks that you're supposing that to, that you're including in that process. So that's not actively under consideration. But it is something that we have, we haven't simply brushed it off. We have given thought to it.
Any other questions? I think there's someone right there.
Randy, thank you very much for those very interesting remarks. One of the things you didn't discuss in the evolution of stress testing, or things for the future, was the incorporation of GSIB capital surcharges into the stress test. Now, as I understand those, part of the rationale for them is that a failure, one of the very largest failures, would have very large loss given default. And in order to make the expected loss from those very large institutions equal to that of smaller institutions, so you wouldn't have to fail, you have to reduce the probability of default. And the way you do that is with higher capital surcharges. So we had the enhanced supplementary leverage ratio, which was 5% for the holding company and 6% for the insured depository. And then I thought you had a proposal, or the board had a proposal, that would replace those with some share of GSIB surcharges, risk-based surcharge. So my question is, first of all, why aren't those in the stress test? It seems to me the minimums for those have a rationale. And also, why would you want to replace the enhanced supplementary leverage ratio with surcharges that come from the risk-based element rather than the original? Isn't it a watering down?
Okay, so with respect to the GSIB surcharges kind of being measured post-stress within the stress test, actually, I mean, we have proposed to the great distress of many people in this room, I know, but I have, I do believe that intellectually measuring the GSIB surcharge post-stress is the right intellectual construct for the reasons that you described. Given the purpose of the GSIB surcharge, that is something that should stay in place even post-stress. So I do think that intellectually that's correct. That's a separate question from whether we have calibrated the GSIB surcharge appropriately, and it puts a strong premium on that question. If it's going to be in the stress test calculation post-stress, then the fact that we have essentially doubled it over the minimum internationally agreed, over the internationally agreed minimum, that may or may not make sense, but it certainly shines a light on whether that calibration is correct. And we've said we're looking at that in the context of the overall capital requirements as they exist and as they're going to evolve over time. That was something that a couple of people this morning mentioned as well. You've got a whole bunch of things that are still in the pipeline to be implemented that could significantly affect the capital requirements of firms, and all of that needs to be thought about as a whole, as opposed to piecemeal. The second issue, though, as opposed to the enhanced supplemental leverage ratio and the leverage and where we have calibrated it, and the fact that we downshifted the enhanced supplemental leverage ratio to the internationally agreed standard. It had also been higher. That, I think, is kind of that was a fairly straightforward optimization question. I don't view that as a watering down. I view it as a response to a regulatory incentive that we had created to actually increase risks in the most sensitive part of the financial system, the insured depository institutions. Where the result of the calibration, where we had put it, perfectly sensible. If X is good, 2X must be better. So that's a perfectly sensible response. But it had resulted in the fact that for a number, a number of our largest financial institutions for their depository institution subsidiaries, that leverage ratio, that non-risk sensitive ratio, was their binding capital measure. And if you have a non-risk sensitive measure as your binding capital measure, that is a regulatory incentive for you to increase risk in your portfolio, because the capital charge for any particular asset is going to be the same. And so you ought to put on the asset that has the highest return, which will be the riskiest asset. That's a perverse result. We should not want to create a regulatory incentive for banks to increase risk in their portfolio anywhere for banking organizations, but certainly not in an insured depository institution. So it was, I suppose it was fortuitous as much as a consequence of precise calibration, but by turning the calibration of that enhanced supplemental leverage ratio down to the internationally agreed standard, that had the effect of relieving the capital requirement at the depository institutions, but because of the rest of the capital framework, not materially relieving the capital requirement at the holding company, so that capital could now move out of the depository institution to the holding company. The overall amount of capital that could escape from the system was only about 0.04 of 1% from the holding company level, so that the depository institutions no longer had that perverse regulatory incentive, but the banking organization as a whole still had all the capital that had been in it before. And not only was it the Fed's traditional source of strength doctrine that would allow that depository institution to be the first claimant on that now freed capital in the event of some future stress, but that had been enacted into law in Dodd-Frank, so that the depository institution was the first claimant on that excess capital. So, you know, when you look at that, you say that is just, I think anyone looking at that complex of facts would say this is something that we ought to do. It was not a weakening of the system at all. Not at all. So those are my response to those two questions. I think they were two separate questions, but if I understood them.
There's a question right up front. I don't know who the...
Hi, Victoria Guida with Politico. I wanted to ask about the qualitative objection. I know that you mentioned in your speech that banks still go through a qualitative assessment, and a lot of people argue that this effectively means that the result is not any different because the Fed can still punish banks for flaws in their capital planning process. But I was wondering, what was the compelling reason to get rid of it? Is there a public benefit to not having a qualitative objection?
I think that there is both a public benefit. There's a public benefit and a supervisory management benefit for treating like things alike. And we have a lot of important concerns with respect to banking institutions that we engage with them on in a regular supervisory process. And in the immediate aftermath of the financial crisis, and for some period of time, what I think many people would think was perhaps a surprising period of time after the financial crisis, there were material weaknesses in an extremely important area for the banks in the qualitative area of their capital planning. It's just a fact, and again, it's not surprising. It was the result of that very heavy engagement with the banks over the course of a decade that their capital planning has gotten much better for virtually all of them. And I would expect for those banks that still haven't made that transition, they'll be able to learn from the experience of other banks. That will probably happen faster. All of that's how one would expect the universe to evolve. And that in a universe where capital planning is now, I would say, at a par, maybe even above the ability of the banks with respect to other important elements of their operation that we also supervise, that we should supervise that in the same way and engage with them holistically on their governance and controls, essentially, around capital planning and around many other aspects of their operation, and recognize that this, what was an extreme deficiency has now moved up to sort of a level playing field with other concerns.
There's a question from Jared, who's sitting in the middle.
Yeah, hi, Jared Seberg with Cowen Washington Research Group. Just a quick question on dividends versus buybacks in the test. We had heard for the early years that there was a 30% cap on dividends that seems to have largely disappeared. But still, there are some questions about how quickly banks can turn dividends off and how willing they are to turn dividends off. Can you talk a little bit about how you see the balance between those two capital distribution tools?
Well, I think I think I view them probably largely the same as most people in this room. I mean, it is the case that it's harder, both as a practical matter and as a historically revealed fact, to turn off dividends than share repurchases. But both are restrictable, but as a consequence, I think any change to the dividend, to the dividend pre-funding assumptions in the stress test would have to be accompanied by quite a concrete and evident agreement on the part of the banks and the regulators that as one chews into the buffer that would result in a decrease in distributions, that would also affect dividends more rapidly than it had in the past if the pre-funding assumption were going to be changed. It is the case. It was always the case. It was the case before the crisis. That was not just a bank problem. The bank regulators have always had the ability to prevent a bank from paying out dividends if they thought that it shouldn't. And we didn't turn off the tap any faster than the banks did. And so I think, on the other hand, it is possible for us to do that, and we should very clearly explain how we're going to do that, and that we're going to do that if there is a change in the dividend pre-funding assumption.
So we have time for one more question, and there is a gentleman right there in the middle.
Hi, Randy. Bob Ziska from Capital One. I was wondering if you would be willing to share your view of the odds of implementing the stress capital buffer proposal for CCAR 2020.
They are good. It is, yeah, Lisa would like to know the same thing. It's still our objective, and I still believe an achievable objective, and a very high priority for me to have that done with the appropriate responses to the comments for the next cycle.
I think, unless if there's any other questions, there's one more question. I think we can just take that. It's right in the very front, in the middle.
Hi, John McDonald from Autonomous Research. Just wondering about the interaction of CECL with the stress test program, and what are your thoughts on the challenges of integrating that? And if we do push it off for a couple of years, what it seems like we're going to, what are the challenges of banks kind of operating with a CECL mindset and not using that mindset in the stress test scenarios?
So it's interesting. I mean, the current reserving methodology really is different than what we use in the stress tests, right? We have, as opposed to looking at the bank reserves, as opposed to, what is the day one amount, but the reserving methodology, other than that, doesn't really factor into our projections of losses and and the bank's performance during the period of stress. And and our proposal for at least the first couple of years is that that would not be the case. I think actually that my expectation, although we'll learn a lot about CECL, and I'm very open to learning about CECL during this phase-in period, more than a lot of people, I think we may find that there are consequences that we have to respond to. I think a lot of folks in the official sector believe that when we actually see how it functions, we'll determine that there's, that there's not a required response from the regulatory cycle. It's not going to be as dramatic an effect as people are thinking. I'm certainly open to the view that it may be a material effect that we have to respond to. But I think that's probably likely to be easier to do in the stress testing environment than elsewhere, and it may in fact have a positive effect for banks. If it does increase the day one reserve that banks have, that's just going to be more for them to chew through during the stress test, and actually ought to ameliorate the effect of the stress. But we'll learn how all of that works during the phase-in process, and are very open to making changes if they're necessary. It's not a phony phase-in at all. To sort of pull the Band-Aid off slowly, it really is what will we learn during this phase-in.
Great. Thank you very much, Vice Chairman, for your candid response. and thanks, everybody. I think we're going to take about half an hour break and come back at 3:30.
the Fed's periodic assessment of financial vulnerabilities and its new biannual public financial stability report. Andreas is another of the pioneers in the design and oversight of the bank stress tests that we have with us today. Please welcome Andreas to the stage.
Okay. Okay, hello. Let me just take 1 minute to introduce the distinguished panel that we have here. We're just extremely fortunate to have some very strong thinkers. Of course, Nellie Lang, currently Senior Fellow at Brookings Institution, my former boss. Till Sherman, another person that we were all in the foxhole with 10 years ago, currently partner at Oliver Wyman. Jared Seiberg, Managing Director at Cohen Group, a talented ultramarathoner, and Buzz Roberts, President and CEO of the National Association of Affordable Housing Lenders. Nellie's going to give an initial presentation, about 20 minutes, and then each of our panelists will give remarks, and then we'll have Q&A from the audience. Thank you.
Okay, so let me start by saying thank you very much. One, for everybody to come back. I know Vice Chairman Quarles already said that, but this really means at 3:30. We really mean this. And thank you to Vice Chairman Quarles and the conference organizers for the invitation to write a paper for this event and contribute to the public's input to the Fed's review of the stress tests. Let me get this straight here. Okay. This paper that I'm going to talk about today is written by Don Cohn and me. And I would start by saying we agree fully with the Vice Chairman's stated objective, which is to preserve the strength of the stress tests and while improving efficiency and transparency. So we were asked to discuss, to address the question of what are some of the effects of the stress tests. And this was on broader economic and financial conditions. Now, a challenge for writing this kind of paper is to separate the effects of the stress test from the effects of all the other regulatory reforms that have taken place over the last decade. So we have, of course, higher capital requirements and liquidity requirements, and then banks' own changes in their risk management practices. So we tried to frame our questions to try to get to the stress test effects. And so what did we focus on? We tried to separate them from higher regulatory capital requirements. So what is that? That the stress tests are more forward-looking and based on tail risks. And they probably have different effects on bank risk management than, say, regulatory capital requirements. We used, for this paper, a lot of public data available. So I'm not at the Fed anymore, so I don't have access to some of the data I used to have. We also reached out and talked to many experts. So, in fact, we talked to 17 different individuals that represent the bankers, the investors, the regulatory community, and then we reviewed some empirical research. So we settled on 3 particular questions. One, have the stress tests helped to counter potential procyclicality of bank capital? So that's one of the features of stress tests that distinguishes it from regulatory capital. 2, have the stress tests improved risk management and capital planning at tested institutions? And 3, have the stress tests affected the cost and availability of credit from the largest banks? I would start with a big caveat. Many of the potential benefits and potential costs of stress tests are through a full economic cycle, and we haven't had that yet. So we only can observe what's happened so far, which is we've had an expansion without a downturn. So I want to make that caveat. But having said that caveat, to preview, I'm going to say all our answers to all 3 of these questions is yes. Maybe a qualified yes, but yes. But I think the answers are a little more interesting than that, so that's what I'm going to talk about today. And we aim to provide, answers to these questions in a way that hopefully provides some insights to any proposed changes to the stress testing program in the future. So just to start on the first question, stress test capital program designed to make capital requirements less static, help counter procyclicality. just a little aside there, I think there was some question about whether stress tests should aim for countercyclicality, to help counter procyclicality. I think just one issue is with the large banks, they are all subject to the same systemic risk. They're all subject to macro shocks. It's hard for them to sort of hedge against macro shocks in the US system. So this is more, that's the countercyclicality in some sense that you want. You don't want them all to take big losses at the same time. So that in that sense in which countercyclicality or countering procyclicality is useful. There are two features of the stress test program that I would highlight today. One is the macro scenarios, as you all know. They can be more stressful when times are good and can include new risks. And then there's a second feature, which is it requires banks currently, the current program, to pre-fund shareholder payouts. And as you know, CCAR is the binding capital requirement, and the pre-funding is of proposed dividends and share repurchases. And then DFAST, which is the formal stress test required by Dodd-Frank, but is not the binding capital requirement, it assumes dividends at the past rate, annual rate, so it's observable. Okay, to start, I'm gonna use some pictures. I've noticed, but I like pictures, so I'm going to use some today, and hopefully they'll help the discussion. So if you start with the right, this is the stress test capital buffer. Under CCAR, which is the light or the purple bars, and DFAST, which is blue. And it's defined by the decline in the common equity ratio from starting to minimum, okay, which is which is the constraint. And as you can see, this is 2014 to 2018. The purple bars on net are up. They're not, it's not this straight upward trend, but on net they're up. So they've helped keep capital at higher levels. And you can see that on the left chart, which is you see the rise in common equity tier 1. It's risen, and around 2014, it's kind of stayed flat. So I think the stress tests are helping to keep that, keep capital at this higher sustained level. So in that sense, it's had some benefits. Some of that, of course, is from the unemployment rate. So this is a chart you've all seen many times. The macro scenario is often defined by this unemployment rate. So on the left here, you get from 2006, you get the rise in the unemployment rate and the decline. All those colored lines are the different scenario projections. And the very last one is the 2019 scenario. The orange is the 2018. But what you see is the deltas keep getting bigger and bigger as the unemployment rate gets better. So that's the kind of counter-cyclicality that has been built in, and that is part of the guidance that has been put out. On the right is the BBB corporate yield. So I picked one asset price to show here. And you can see that also has sort of the similar properties, that when the yield is a little high, the increase is not as big, and when the spread is low, the increase is bigger. In 2018, you get a big rise. This is the aversion to long-term fixed assets that was put in the 2018 stress test I referred to earlier. So this is introducing some volatility, some salient risks. You can argue about whether it's too volatile, too uncertain, but I think the idea that scenarios should capture real-world uncertainty is not arguable. You don't want more certainty in your scenarios than you feel that there is in the real world. They should reflect that. So I think that whether that was the right one, people can argue about, but I think that's in some sense what the scenarios are about. But what I want to point out here is these unemployment rate, the deltas continue to rise each year. The buffers have not. So I think you're only going to get so far with the macro scenarios. So here's the capital buffer, where I'm going to split it up between what I'll call net losses and what are the dividends, the pre-funded dividends. And I'm going to use DFAST capital buffers because we know what dividends are. And CCAR, you don't know proposed share payout, so you can't really quite get to it. So this is sort of net losses. And the blue bars are the GSIBs, And the orange bars are the non-GSIBs, and we're looking only in this example at domestic bank holding companies. So there's about eight of them in the blue, and there's about 15 or 17 in the orange. So clear, same story, not a clear trend for the GSIBs. They're substantial, and this is a percent of risk-weighted assets. And then for the non-GSIBs, there's actually an upward trend. These net losses have gone from 1% to 2% over this period. So we do see some upward trend. And then here's the counterpart to it, which is the dividends. And to do dividends, what we did was we estimated the dividends that are in the capital ratio to the minimum. So our assumption is that the largest GSIBs, their binding capital ratio, their minimum capital ratio is at 5 quarters, okay? Whereas for the non-GSIBs, it's at 8 quarters. So these dividends represent payments out to the minimum, okay? So you can see like the dividends for GSIBs look a little lower, and that's partly because it's 5 quarters. And you see the dividends for the non-GSIBs are higher, but they're flat. So DFAST buffers are rising for the GSIBs from the dividends, but it's a small piece of relative to the big losses they had. And then the non-GSIBs is more static. The takeaway so far, and before I get to the share repurchase piece, is the DFAST buffers provide some counter to procyclicality. You might have expected capital buffers to fall given the improvement in the economy and the better balance sheets. And this is offsetting some of that. But it's now let me just turn to the next piece, and I think this is the important part that this is just set up. The CCAR is the binding capital constraint, so that's the one the bankers care about and is actually what causes behavior. So here's the share repurchases. So because we can't observe proposed, these are just actual. And this is from 2014 to 2018. And the GSIBs, you can see, now that is trended up sharply. And for the non-GSIBs, it has also trended up sharply. So the takeaway here is that for the GSIBs, you're going to get most of your procyclicality, most of what to counter the procyclicality from the repurchases, plus a little bit from the dividends. And you also get it for the non-GSIBs. So this is going to emphasize the importance of the share repurchases. And I'm going to come back to this in a second. So we wrote our paper and give it to our discussants and several weeks ago, but I just thought the 2019 results were released, so I just wanted to add this. This is all the firms, and we're not separating them, but it reflects largely the GSIBs. I think what this does is it reinforces, this picture is going to reinforce that a lot of what is going on with capital buffers right now is from the shareholder payouts. So the black bars, again, are the DFAST capital buffers, and those have fallen from 2018 to 19. And the difference between the DFAST and CCAR in 2018 and 2019, it's quite large in 2019. So that's the proposed shareholder payouts. Now, the CCAR buffers came down, but they're still high. So it's, I think it's still achieving. As I said, it is achieving, it's countering the procyclicality. It's just doing it in different ways now that I think are important for thinking about how you might adjust your stress testing program. Okay, so we talked to a number of people through this process, and a couple of bankers actually raised some interesting questions about how will stress testing actually work once a recession starts. So we talk about maintaining higher capital, but like what happens if an actual recession starts and you start to take losses and then you have to specify a new CCAR? And where are we? And are we like, is the system resilient enough to avoid like causing firms in year one to start pulling back because they know in year two they're going to get hit by a horrible CCAR? And so I don't have a clear answer. Let me just put it that way. I don't have a precise estimate, even though there's going to be some numbers on these slides. But I think you can set up a simple example to think through this so that everyone can be prepared for this. So the way we thought about this is how much would capital decline in the first year if you had a recession? So you're going to have some losses. You're going to make some assumptions about dividends and repurchases that you pay out. So what we did for this example, we started with beginning of period capital, which is year-end 2018. And let me just walk through the non-GSIB. So they start with 11.9% capital, an average non-GSIB. We assumed half their losses from the buffer, so that's 1%. That's the -1. Then we assume dividends continue to get paid out for 4 quarters. That's another 0.5. And then we assume repurchases are only paid out for 2 quarters, and they shut them off to 0 for the second 2 quarters. So that's an assumption that you can change. They end the year with 9.8. The GSIB starts with a little bit higher capital, 12.3. Again, this is an average. And maybe there is no such thing as an average, but this is average. And they're going to take half their losses, which is bigger, and they're going to continue to pay out dividends, and then they're going to pay out only half their repurchases. So they end with 8.8. So what happens in the following year? Let's say we have a recession. What happens in the following year? The next scenario, there will be a next scenario. There's guidance about it. If there's actually a recession, the scenario will be less severe. So that works in that favor. And then we can assume that no repurchases and no increase in dividends. But dividends continue, but there's no increase. Then you can calculate what's the maximum stress test capital buffer that a bank could take before falling below 4.5. Before the supervisors would have to publish that your bank had fallen below 4.5. And so I think here, the non-GSIB, it would be 4.3. That's a pretty big number, and the range over the last 5 years is between 1 and 2, so it's pretty unlikely they're going to end up being binding if they've shut off all their share repurchases also. Now the GSIB, though, you're at 3.6. The range has been, 3.5 to 5.5, so they're kind of in there. So I think this example, and this is a very simple example, and it's in the table in the paper, and you can kind of just change numbers in it. The average non-GSIB is almost certain to be above a minimum, but the average GSIB is going to be closer to the constraint. And I get, again, to emphasize, this assumes 1.5 years of repurchases have been shut off. That's about 2 percentage points of capital. So this really is highlighting the importance of the share repurchases. So 2 aspects, as I mentioned, contribute to this. The severity of the scenarios. You can reduce the scenario severity, and you probably will, and I think that's the appropriate thing to do, and that's the way the guidance is. There will be some limits on that, because once a recession's underway, investors are going to want some assurance that banks can kind of survive the recession and won't contribute to it. So there's going to be some kind of limitations on where you can go. And then, of course, your starting capital ratios is the other sort of thing you can maneuver. And so I think the underlying principle, if you have higher net losses and higher dividends, you should probably have higher starting capital ratios. As I said, share repurchases have been a significant loss absorber. One way is the alternative is the GSIB surcharge. Another alternative is the countercyclical capital buffer. Some combination, but these are all trade-offs in terms of avoiding capital falling so that banks are going to have to try to raise equity in the middle of a recession. Okay. So to answer, the stress test helped to counter potential procyclicality? Yes. Though more from the requirement to pre-fund shareholder payouts than the macro scenarios, at least in 2018 and 19. Have the stress tests, question 2, and I'm going to have to go through these a little more quickly. Have the stress tests improved risk management and capital planning at tested institutions? And we, as I mentioned, we talked to at least 17 individuals, and the answer is yes, absolutely. And most believe they are driven importantly by the public qualitative assessment. And there's a very broad agreement on improvements. There's better data, better risk identification and measurement. People are looking at tail risks. They're assessing the capital implications of these tail risks. There's much stronger governance and a link between risk and capital planning. The chief risk officers are talking to the chief financial officers. There's just risk management on a much more holistic basis. There was a little less agreement on whether the public assessment is still needed, and most expected some backsliding. And I think there was some acceptance that that's acceptable because the bar has been raised. Don and I, kind of as part of pushing out, it would really be great. We talked to everybody. We asked everybody, how do you measure this? And there isn't a uniform, there's just not a good measure. And it feels like if the supervisors want to remove the qualitative objection, which they have, and it seems there is a public benefit to that, it could be replaced. Is there something to replace it with that would be useful to discipline not just the banks, but the supervisors? Like, how do you continue to convince the public that the supervisors understand what is happening? And one other aspect of the risk management is the capital plans are much more conservative. Some of this, I'm sure, is from the implicit 30% payout. You can see total payouts. This is mean. Total payouts to risk-weighted assets have gone up a lot over the last few years. To the right, you can see that the share that is the dividends of the total payouts is much lower now than in the pre-crisis. And given dividends are much stickier than share repurchases, which are related to free cash flow, this will add to the resilience of the financial system once a stress hits. Okay, I'm going to say just a couple of things on the last bullet. Third question, have the stress tests affected the cost and availability of credit from the largest banks? We reviewed a number of papers, a number of very good papers, and there's a table in our paper that highlights the data that's been brought to the issue, how they try to identify the stress tests, and some of the basic results. One takeaway is it's pretty difficult to isolate the exact effect of the stress test, given all the other things that are going on. But we would conclude from these studies that credit from the stress-tested banks has been reduced. But total credit might not be. So there are higher loan spreads, less credit, and these loans, though, are less risky for the banks who have the larger stress test capital buffers. Now, there are some studies that actually can use loan-level data and can control for demand a little bit better. So literally borrowers, and the borrowers can borrow from which bank, based on their stress test buffer, or they can use county-level data. So large business borrowers in general will get less credit from the large stress-tested banks, but they have many alternatives, including smaller commercial banks and capital markets. Smaller businesses have fewer alternatives, that is for sure. But the market level data suggests that overall credit growth at the market level does not fall. So there's some evidence of substitution to smaller banks and some evidence of substitution to non-banks. So our takeaway on this is bank credit from the tested banks is reduced, but it may not be a bug of the stress test, it might be a feature. But I think some more work here could be done. Clearly, credit growth was very rapid before the crisis, and there's strong evidence of higher default rates for non-local market loans. And the reforms clearly were intended to reduce some credit growth in exchange for reduced probability of failure of the largest banks who have the greatest externalities. So there still needs to be done a welfare analysis of the credit provision of less from stress-tested banks and more from smaller commercial banks or non-banks. And then another factor I would just mention is studies have looked at transition effects. So these are short-term effects, and long-term effects of capital requirements in general have been shown to be lower when you have the ability of monetary policy to offset or other policies to offset higher lending rates. I think that's our takeaway there. So our questions, just to summarize, have the stress tests helped to counter potential procyclicality of bank capital, which is necessary to support lending? Our answer is yes, which should help support lending in the next recession, which I think is a good goal, though more from the requirement to pre-fund shareholder payouts than the macro scenario in the last few years. Have the stress tests improved risk management and capital planning at the tested institutions? Yes, absolutely, and driven importantly by the public qualitative assessment, though that doesn't mean that public qualitative assessment needs to be maintained, just means something needs to be done, though, I think. And then 3, have the stress tests affected the cost and availability of credit? Yes, it has. It's reduced the credit, but this may be a feature rather than a bug. And of course, the caveat to we haven't seen how this all plays out over time. So thank you very much.
Till will be our first discussant.
Thank you. I'm about to learn the calibration of my progressive lenses to see if this is, see how that works out. So first, thank you, Andreas, for your kind introduction. I really want to thank the conference organizers for inviting me to join this panel to talk about one of the things I like to talk about most, something that's near and dear to my heart, and that is, in fact, stress testing. So stress testing was the tool of choice to help right the financial ship during and after the great financial crisis. Describing a concrete scenario that banks must survive, and in fact survive well, is relatively easy to understand, and it's relatively easy to communicate. And in the middle of a crisis, good communication is a real virtue. In 2009, the U.S. bank stress test, the SCAT, which covered, as Governor Quarles reminded us, about 2/3 of the U.S. banking system, asked banks to be able to absorb loan losses exceeding those that actually happened during the Great Depression. I think that's pretty convincing and, in fact, comforting. And apparently at the time, so did the market and the public. It worked so well, in fact, that banking systems of countries representing more than half of world GDP now have stress testing as part of their regular bank supervisory process. It's hard to overstate the impact that stress testing has had on banking stability, both as a tool to help us get out of the financial crisis, and thereafter as a program to regain and maintain a stable, resilient, and healthy banking system. The US, through the CCAR program, has been leading the way, both as a financial crisis first responder and also in the migration to financial peacetime stress testing, now in its 9th year here in the US. Other countries have been watching this experiment we're running, and they're adapting a lot of the practices, but they're not adapting all of them. So against this backdrop, Nellie and Don's paper represents, I think, an important assessment of the most advanced and sophisticated, but also most intrusive stress testing regime across the globe. They've done a remarkable job, I think, of providing, much like CCAR, a quantitative and a qualitative assessment of that program. So on the quantitative side, my takeaways were, first, the importance generally of buffers. So this is a big change from pre-crisis. It was introduced in the SCAP in 2009, this notion that you want to be prepared for the crisis, and you want to do that with a capital buffer to make sure that you remain above the minimum. This basic idea was then formalized in the Basel III approach to capital adequacy. It recognized that a bank needs to be able to survive not just one, but multiple hits. After a shock that eats away your buffer, you still need enough capital to keep going with market confidence and maybe survive some more losses. For me, the most surprising finding of their paper, though, is the relative importance that capital action pre-funding has played in both the amount of capital buildup and the countercyclical effect since the maturing of the program. So if crisis or wartime stress testing is primarily about getting capital into banks, then peacetime stress testing is really thinking about the conditions that regulators might get comfortable with to let capital back out of the banks. So it's really, in that sense, a short step from wartime stress testing to peacetime capital planning. Nellie and Don's exercise of working through what might happen following a serious but not extreme recession, where capital depletion is about half the past stress tests, which, to be sure, that is a pretty severe recession for that to happen, I think is especially instructive since it tests this idea of buffers a lot more directly. Now, on the qualitative side, as one migrates from crisis to financial peacetime, you can afford to, and indeed one should really concentrate a lot more on the qualitative aspects. Stress testing is really useful for this. Much like the SAT, same tests, same time, same conditions, everybody has to sit down and take it. Same number 2 pencil. They don't do that anymore, I know. Dating myself. So, US is the only country, that, however, that has a formal pass-fail for qualitative assessment, at least still. And the authors note that perhaps the only thing that all their interviewees agreed on was that this helped to improve risk management control practices at banks. My own experience certainly corroborates this finding. And it's startling, at least to me, how much further the US banks have advanced on this front than banks elsewhere. At least that's from my own observations, and that's those of my colleagues. So note that the supervisor's day job has always been to conduct qualitative assessment of banks' practices to ensure that they conduct their business in a safe and sound manner. But the concurrent stress test program has proven to be especially useful and an especially powerful tool for this task. Moreover, the public nature of the qualitative fails really focused the minds of senior management and boards, an observation that's, of course, also made by Nellie and Don. Other regimes use the stress test as a valuable input to their over-supervisory assessment as well. The European approach is to use capital as a mechanism to motivate banks to improve their risk management and control processes, but without resorting to outright public failure. Judging by some of the past failures in the US of highly capitalized, even post-stress banks on qualitative grounds, US regulators don't seem to view capital as a substitute for poor risk management, a point of view I agree with. So I want to place the US program in the global context and compare CCAR to the EBA, the European Banking Authority program, for banks throughout the EU. So the US economy is up just under a quarter of world GDP. The EU is about the same. So by looking at these two regimes, we cover almost half of world output. So here are just a few differences that I think are worth noting. So first, the EBA conducts a stress test only every other year, a cadence that the US is also contemplating. Dividends and share repurchases, importantly, do not need to be pre-funded through the stress scenario. If a bank finds itself depleting capital through the scenario, it can stop the share repurchases and even dividends to husband capital in order to pass the post-stress hurdles. Within limits, of course, this approach actually is also part of the CCAR program, but not under the Fed scenario. It's only so under the bank's own scenarios under the so-called alternative capital actions. Now, this is clearly more realistic, as Nellie's analysis of the capital distributions in her crisis example or her severe recession example shows. But supervisors are understandably skeptical of what banks might claim that they might do when confronted with a monster of financial crisis, especially, since at the time it might seem just like a little monster. The EBA does not explicitly fail banks for qualitative reasons, something the US program has already dropped, of course, for the large but non-complex banks, and is in the process of phasing out for all banks. Instead, they incorporate the learnings of the stress testing exercise into their overall supervisory assessment of the bank, which may result in additional capital requirements. I want to return now to this notion of buffers, which I think is a really key feature both of the CCAR program, but also really of the whole post-crisis regulatory regime. The US program has generated average capital depletions between 3 and 4 percentage points of CET1 capital, which is this metric of high-quality capital, the metric also that Nellie uses. It's essentially figure 2 of her paper. So when you include dividend and share repurchases, you essentially add another 1 or 2 percentage points to this number. The damage for GSIBs is higher. It's like 4 to 6% on average, without the dividend increase and share repurchases. And one reason for that is that they have to add this counterparty default that the other banks do not have, that are not subject to. Now, this extra absorption actually is not all that far from the average GSIB buffer these banks have to hold. The European experience is similar. The EBA in its 3 runs so far has resulted in a 4 percentage point average depletion, pretty much steady from year to year. The Bank of England's program, which is now in its 5th year, is a bit higher. It's been between 3 and 6 percentage points. So this gives us a concrete idea of the kind of resilience to economic and financial shocks that we expect, or at least that the regulators expect banks to weather. The scenarios that the authorities expect banks to live through are at least as severe, and in most cases, more severe than what we actually experienced during the financial crisis. Now, that's important because if we're collectively able to judge the stress testing programs, we should look both at the inputs, at the scenario, is it really severe enough? But also we have to look at the resulting damage. Is it plausible given the scenario that we're looking at? So we've taken at least some lessons from the financial crisis quite seriously. Banks need to hold at least double the required minimum amount of capital, enough to absorb a severe shock and still meet the minimum after the shock to be able to provide credit to a then limping economy and get it back on its feet. And in reality, of course, banks are holding a lot more than just double the minimum requirement. Now, this narrative of layers and buffers to absorb shocks is especially pertinent for the GSIBs, and we ask them to hold more and thus be able to absorb more. These abstract buffers and numbers are made concrete with the intuitive language of stress testing and resulting impacts on banks. It helps us to understand whether the capital requirements that we impose on banks are big or small, or high or low. So let me wrap up by just reflecting on the fact that the memory of the financial crisis is receding. It's been a decade in the US, and as of this month, we're experiencing the longest post-war economic expansion. We've been enjoying a long stretch of financial and economic peacetime. But the peace that follows a crisis eventually evolves into the time just before the next one. I don't know what that crisis is going to be, but I do know that the risks that dominate the agenda of the risk organizations at banks and other financial institutions are actually not financial. They're non-financial. Cyber, technology, even climate are the issues that are preoccupying chief risk officers. And in my view, rightly so. Frankly, I don't really worry all that much about a financial market crash or a severe economic downturn bringing the banking system to its knees. But we can't be complacent and just pat ourselves on the back for a job well done in building resilience to all these financial and economic shocks. We need to focus a lot more attention on the non-financial ones. So expanding stress testing to include a wide range of non-financial shocks, I think, is the real frontier. The Bank of England's contemplation of including a climate shock in its biannual exploratory scenario in 2021, I think, is a really interesting idea. So on that cheerful note, what did you expect from a stress testing conference? I'm going to end my remarks.
Thank you, Till. And when Till said that the expansion is the longest post-war expansion in the United States, he, of course, was referring to the War of 1812. I think this might be the longest expansion since the NBER, record-keeping began. With that, Jarrett?
Great. Thank you to the Federal Reserve for inviting me to this conference. Thank you to Nellie and Don for a very thoughtful paper. And of course, thank you to everybody who is still here. I thought for sure once the Vice Chairman finished his remarks that everybody was going to flee to enjoy the beautiful outdoors. And I appreciate you persevering through our final panel. I think work like this really is critical because it's so easy to forget what it was like in September 2008 and how much damage the financial crisis did to the economy globally and to families at home. As such, I think everyone can agree on the value of having a well-capitalized banking system that can clearly survive financial shocks. The issue, of course, is where do you draw the line and how do you evaluate proposed changes to the stress testing regime? So I have a interesting job. I am both Washington and Wall Street. Yes, that means in some circles I already have 2 strikes against me. And my ultra running lifestyle may very well be that 3rd strike. But it also means that I have a unique perch that lets me bring both a political and a market perspective to this conversation. And as a sell-side analyst, I will give you my conclusion up front. The SCAP CCAR regime was part of the trinity that saved the financial system from collapse. Unlimited deposit insurance stopped runs on banks, and the liquidity initiatives kept markets operating. The Supervisory Capital Assessment Program, however, is what made it possible to invest again in the banking system, as it restored trust in how the government measured solvency. To quote Chairman Powell, or at least the remarks that we saw him say, even if we didn't quite hear him say it, the stress testing, quote, helped restore confidence and stabilize banks by providing a credible and independent picture of their finances. As such, I believe each change to CCAR must be evaluated through the lens of whether it enhances the market's trust in the government in the next severe economic downturn, and in how the government is going to evaluate the health of banks in that situation. My concern is that some of the changes already implemented and others being considered may erode the market's trust in CCAR as a measure of solvency. And I believe if this continues, it may endanger political support for stress testing, and it may make the next banking crisis even more challenging to manage. So let's spend the next 4 or 5 minutes and dig a little deeper into this, and I promise I'll keep it to under 10 total. So my experience in 2008, being in Washington and being in the industry, is that the market lost confidence in how the government measured solvency when FHFA put Fannie and Freddie into conservatorship just a few months after the government urged investors to buy GSE preferred stock. In effect, the government said to ignore the previous reported capital levels because those numbers were so inaccurate that Uncle Sam had to seize the company. Imagine that if you're an investor. One day you think they're solvent, the next day they're not. The market's confidence in how the government measured solvency took a further blow when Lehman Brothers failed. The market's expectation was that Treasury and the Federal Reserve would not permit an investment bank to collapse because of crisis-induced liquidity and capital troubles. Bear Stearns was supposed to be the resolution model. We can debate endlessly whether that was the right model or not, but that was the expectation at the time. What I noticed at this point in the crisis is that our clients, the institutional investors out there, stopped evaluating bank solvency based on the Tier 1 capital ratio. Instead, they looked at tangible common equity on the theory that this was pure loss-absorbing capital. If there was enough loss-absorbing capital, then the government could not seize the bank and wipe out their investment. And even then, there were doubts about this calculation. To me, that is what made the Supervisory Capital Assessment Program so important. The government put the 19 biggest banks through a tough stress test and told the market how much capital they needed to raise to ensure those banks would survive. And it vowed to fill that capital hole with government money if the private market did not step in. This gave investors trust on how the government would measure solvency. This is not just because of the stress test. It was also because the market believed the government only would invest in a bank if it intended to let that bank stay in business. It was this taxpayer exposure that gave the market trust in the SCAP result meaning something. The end result of this newfound confidence is that these banks were able to raise the capital needed, as my fellow panelists were talking about. The May 7th, 2009 SCAP release, in my view, represented the end of the banking part of the Great Recession. So then the Federal Reserve came along and it crafted CCAR to further cement trust in the system, and they added the qualitative review. Not only was the government now telling investors how much capital the big banks would need, but it was also reassuring the market that these banks were managing risk and planning for their capital needs. In other words, the market could have added confidence in the solvency of banks that passed the qualitative assessment. So now we have proposed changes to CCAR, both those implemented and those proposed. To me, the discussion of those are the critical part of Nellie and Don's paper. As I see it, these changes are uniformly positive for the bigger banks in the short term, reduces volatility around CCAR results, and at the margins might even offer some capital relief. Changing the assumption on distributions would further benefit these banks and might permit them to increase distributions beyond current levels. And providing the results before the banks submit their capital distribution plans could ensure no bank is embarrassed for using the mulligan, although why banks are embarrassed for using the mulligan still baffles me to this day. The same is true with the sharing of more details about how CCAR functions. That should further help ensure that banks never fail CCAR. And these are all ideas that much of the market and most of our clients would cheer. Yet I will argue today that some of these short-term positives could be a long-term negative during the next crisis. And as someone who also worked through the savings and loan crisis, was my very first job out of college following FDIC as it moved through Capitol Hill, I know the Great Recession was not a one-time event. There is going to be future economic turmoil and future banking crises. SCAP and CCAR work because the market trusts the government will respect the result. The issue as CCAR evolves is whether that trust will remain. My concern is that this could go the way of Tier 1 capital. That measure became so diluted that neither the market nor the government took it as the serious measure of bank solvency. Were CCAR to lose credibility, it could make it difficult during the next economic downturn for banks to raise fresh capital, which could further exacerbate financial turmoil and lead to more failures and more instability. And that is a problem because politically, trust me, politically, there is no support for rescuing the financial system again. We are not going to have TARP 2.0. And if one could craft a rescue package, the consequences would be severe enough to make Dodd-Frank and the other post-crisis reforms look minor in comparison. To be clear, there's room for change. The vice chairman today noted that the stress capital buffer proposal would reduce from 18 to 8 the number of different capital requirements that apply to banks, and the number of measures of loss-absorbing capacity would drop to 24 to 14. Those changes may very well be warranted and beneficial. One can protect confidence and still provide pragmatic relief. But my message today is that each change to the CCAR regime must be evaluated for the lens of whether it increases or decreases market trust in the results. And there should be trepidation about adopting changes that hurt the long-term market confidence in CCAR. Thank you.
Thank you, John. A final discussant. Buzz, you may need to just advance the slides a couple. Do you have the clicker?
Yeah, maybe. I guess it needs to. Right, but it needs to align. All right. Good afternoon, and I want to thank Andreas and the Fed team for including me in this. I want to talk a little bit about what appears to be an unnecessary, harmful side effect of stress testing on access to investment capital for affordable housing and communities. Because asset classes are broad in CCAR, protections on investments in sectors that can be risky in severe stress scenarios can also curtail investments in more stable subclasses that are both important economically and socially. More specifically, constraints on merchant banking activities of holding companies in high-end real estate is now constraining investment in affordable housing that performs with relative stability even through a financial crisis. And banks are the primary source of this kind of capital for affordable housing, in part because they're motivated by the Community Reinvestment Act, and because other private equity investors are primarily interested in affordable housing insofar as that they can remove its affordability. So there aren't a lot of good alternative sources to the banks. So how does this work? So under CCAR, the Fed specifies assumed loss rates for financing activities of 6 U.S. holding companies and 5 international holding companies that are subject to global market shock. And these companies have 46% of all U.S. domestic banking assets, about $6.8 trillion. In a severe stress scenario, the assumed loss rate for investments in real estate are 45%, and that for affordable housing is almost prohibitively high for banks to consider. And the Fed's caution in real estate investment is understandable and well-founded. Except for affordable housing and other so-called public welfare investments, banks themselves are generally prohibited from investing in real estate. And so the Fed's policy primarily affects holding companies which have been using merchant banking authority to make investments in luxury real estate, and sometimes for trading purposes. In the crisis, investors in speculative real estate did suffer significant losses. Price bubbles appeared, especially in some markets like New York. So, for example, Stuyvesant Town and Peter Cooper Village, an 11,000-unit apartment complex in New York City built after World War II, commanded an unsustainable $6 billion price. And that was based on the false assumption that the middle-income residents of that housing could be replaced by higher-income residents who would pay much higher rents and support a much higher value. That failed, kind of spectacularly, but other less spectacular real estate investments also failed. In some cases, this is because of unfortunate timing of a development process, building a high-end condominium or a rental apartment building or office building that's been started but not completed. When the crash hits, sometimes meant that those buildings remained empty and the investments failed. So these are a little out of frame. You can see actually from this slide, the blue sector represents high-end apartments. It's about 22%, according to this measure, of the multifamily market. The remainder are sort of Class B and Class C equivalent properties, and they really represent the other 22%. And those tend to be affordable to lower moderate income households. Rental housing is disproportionately geared to lower and moderate income households, as most middle and upper income households are homeowners. So CCAR, though, applies equally to luxury housing and most affordable housing. Now, there is a notable exception for investments based on the low-income housing tax credit, which, if we were to flip back to that other table, would show that banks must assume only a 5% loss rate on housing tax credit investments. So that's about 1/9 of the loss rate for other real estate. But tax credit properties represent about 20% of all the affordable rental housing stock. So that leaves an awful lot of stock that is still subject to the higher loss rates. The policy problem is that affordable multifamily properties perform differently and more stably than speculative investments in luxury multifamily properties. So that's because luxury apartments are more vulnerable to demand variations. Only high-income tenants can afford high-rent apartments, and they can easily shift to home ownership, or in an economic downturn, they can simply choose lower rent properties if they need to. You can see that, I think I actually jumped one extra. So you can see here that most of the new apartments that are produced are Class A or high-end apartments. And that exposes the high-end to the risk of overbuilding. And you can see that the Class A, the green part of the bars, represent about 90% of all new deliveries of apartments. In contrast, the supply of affordable rentals is actually declining because the modest number of new additions is offset as formerly affordable units are upgraded and rents are increased. So, not surprisingly, we see that vacancy rates for Class A properties are higher than for affordable properties. The yellow line is Class A, and the black line is B, and the gray is Class C. And the green line, which is labeled affordable, is subsidized affordable housing. Similarly, capitalization rates are significantly lower for Class A apartments than for Class B and C apartments, and that reflects a built-in expectation that luxury apartments will increase in value more rapidly. But of course, in a severe stress scenario, if demand for luxury apartments stagnates or drops, those property values are going to deflate much faster. And indeed, we saw cap rates much more volatile for Class A multifamily properties through the crisis than for Class B and Class C apartments. In fact, affordable properties performed quite well through the Great Recession. There's a lot of data on tax credit properties, and the accounting firm Cohn Resnick found that the financial crisis appears to have had almost no adverse impact on the overall health of the housing tax credit inventory, which marks a striking difference compared with the impact of the recession on conventional multifamily housing. And they also said that consistently high occupancy rates are another indicator of the tremendous imbalance between the increasing demand and short supply of affordable housing properties. And unfavorable economic conditions led to enlarged tenant bases for affordable properties. So the cumulative foreclosure rate for tax credit properties has remained under 1%. We can also see similar kinds of performance differentials in other ways. This is Fannie Mae's multifamily performance compared with its single-family performance. You can see multifamily serious delinquencies, these are 90-day delinquencies, stayed under 1% through the crisis, whereas single-family serious delinquencies exceeded 5%. We see similar results on bank loans. These are 30-day delinquencies, and you can see multifamily stayed under 2%. So it's interesting that other Fed policies explicitly accommodate affordable housing and community development investments, and that's primarily through this construct of public welfare investments, which are limited in volume and limited in purpose and also in other investment terms. So the Basel III risk-based capital rules require for other private real estate equity of 400% risk weight, but for public welfare investments, only a 100% risk weight. And similarly, the Volcker rule has a carve-out for public welfare investments. And this is consistent with the board's stated policy to enable bank holding companies to take an active role in the quest for solutions to the nation's social problems. Unfortunately, CCAR's inconsistency with this broader policy unnecessarily undermines it. And so we think the policy deserves some reconsideration as part of the updating to CCAR.
Thank you very much, Buzz. Nellie, do you feel the need to rebut any of that? Okay, so I'll go to a couple of questions. So first, an easy one. You know, stress tests are dynamic. You know, we're talking about you know, changes to the whole stress testing program. If you guys look down the road 5, 10 years, what are the challenges and opportunities in stress testing? Till got, you know, at least pointed in that direction. I guess this is both like, what should we have up on the whiteboard back at the office? And, you know, what are some of the challenges that might be coming down the road that we need to think about? And we can go down the line.
Thank you. Well, I showed my hand a little bit earlier. But let me expand on this idea. So first, I think making it easier to have sort of a richer, more varied set of scenarios, I think would be desirable. I think one of the really terrific features of the Bank of England's program is the explicit consideration of what they call this exploratory scenario that they do every other year, which is by design, at least the one that we've seen so far, which was 2 years ago, you know, really quite sort of creative. In that particular case, it was threats to business model from fintech, and it also said, you know, don't worry about the 9-quarter. In their case, it was the standard horizon. Think a little bit longer. So having a mechanism and a framework that allows us to be a lot more creative about the kinds of scenarios that we want to explore, I think for me would be the most desirable longer term or medium term feature.
You know, I think you need to sort of bifurcate this issue. I think what's made CCAR effective is that it's focused on financial performance, economic downturns, and the like. The problem is that probably the new risks are beyond that. It's, you know, risk of cybersecurity and what happens if you do have a breach of a bank. It's the risk of the future of a payment system. What happens if we don't use dollars, but we all, you know, use Zucks? I'm sorry, I mean Libra. You know, I mean, there's bigger business model risks that I don't know if those need to be part of the formal CCAR, but I assume there are things that regulators already are stressing these banks on, and I think those need to continue and accelerate.
I just reiterate that as CCAR evolves, we're looking for a little bit more consistency between it and other regulatory policies, especially in areas where banks have a unique role in advancing social and economic equity issues.
Before we turn to the audience, I mean, there's one question that is just, it's come up many times today, and it's front and center in Nellie and Don's paper. So they have Nellie and Don have a nice little example where they sort of work out, if we actually go through, it's a moderate recession at some point, it's at least possible that depending on timing and losses, that some of the larger banks might be required actually to raise capital as a result of the stress tests, and certainly would have a undesirable effect on credit availability and so forth at sort of precisely the wrong moment. What is to be done about this? I mean, till I don't know if in the international setting, there's some consensus on how to approach this sort of issue. If there are policy issues, Buzz, if you have some thoughts on the cyclical behavior of some of these asset classes and their sensitivity to credit supply.
Well, I think so. One of the things we're learning one of the reasons I wanted to have this international comparison is just to get us a feeling for what are the size of the shocks as measured not so much in the scenarios, because those are much harder to compare across countries, but rather in outcomes that the supervisory community seems to want banks to be able to withstand, because the global standards for what the minimums are global. Everybody has the same ones. And what's remarkable to me is that actually there is broad agreement on what is that buffer, and it's, like I said, it's about 300 to 400 basis points. So, if to the degree to which we take, if we take very seriously this, that's maybe not quite enough for the G-SIBs, or even for other banks, then I think the supervisory community has to ask itself, well, what is then the appropriate amount? And what is the mechanism by which to do that? Is it in the US, we already have an additional shock for the G-SIBs. Should that be even larger? But I think that we have a language within which to have this discussion already.
I'm not sure why it needs to be a negative that a bank would want to raise more capital during a downturn. I think I think that's part of banking. Nobody says that nobody says you need to keep 100 cents on the dollar for every dollar that you lend out. And if the market trusts the numbers and the market trusts the management team, I think we've seen that banks have the ability to raise capital. I'm not quite sure if I'm as convinced that they're going to need to. They're earning lots of money and they have the ability to retain those earnings, but I wouldn't view that as a negative outcome just because that's a possibility.
They don't have much to add on this one.
Maybe I can add a little to that. I think the issue of raising capital in a recession is only because that's the most costly time for a bank to raise capital. It's not their first choice of when to raise. And you're right, they can raise it, and if investors have confidence in their soundness, then it shouldn't really be an issue. But I think you're just forcing a trade-off of, should I raise capital or should I cut loans or cut dividends? And those are difficult choices. And from a stability perspective, I think you want the banking system to continue to provide credit through downturns so that it doesn't amplify the downturn, make it worse. That's the objective of in the bank requirements.
So for the diehards in the audience, we have a few minutes to take questions from you. Just a warning that in addition to a mild case of face blindness, I have a not so mild case of actual blindness. So If I don't see your hand up, just wave it stronger. Oh, so, I'm sorry. I'm sorry. Okay, we've got a question right down here.
My name is Joe Riley. I'm the president and CEO of the Community Development Trust. We're a national investor in affordable housing. We've been in business for about 21 years. We're a privately owned, double bottom line company. We have a mission to provide long-term capital for the preservation of affordable housing. We've also got investors who are expecting a return on their investment. The owners of CDT are mostly banks and insurance companies. I'd add that we're a CDFI, we're a community development financial institution. We're a member of the Federal Home Loan Bank of New York, and we're an approved Fannie Mae affordable housing lender. We've done work over the past 21 years that has positively impacted about 125,000 residents in about 45,000 units, affordable units all over the country. And I'd just like to follow up on some of the comments that Buzz Roberts was making. At CDT, we've actually been directly impacted by the issues that Buzz has raised. There have been some banks who have told us they would gladly invest in CDT, but for the manner in which CCAR treats this type of investment. It seems to me that it's probably an unintended consequence that of what is a very important and very valuable initiative overall. But I think it'd be hard to imagine that the intention of stress testing would be to discourage investment in affordable housing, a resource that is in such great need all over the country right now. Earlier today, Governor Quarles suggested that from a regulatory standpoint, it's a good thing to treat like things alike. And I would encourage the Fed to do that, to do just that, treat like things alike. I would encourage the Fed to treat an investment in entities like CDT, which support the preservation of affordable housing, as public welfare investments. The same treatment as the current treatment for low-income housing tax credit investments. Both support the development and preservation of affordable housing. And I think that they're alike, and we should treat them alike.
Thank you for that. Just when we talked to Buzz before this event, it took us a while to sort of understand, what the issue is. And just to be clear, I think this is an instance where a particular asset class is being subject to the global market shock, but it is a hold to maturity asset, and there's, it's certainly worth revisiting this question of whether it is something that we should think about the losses associated with the instantaneous mark-to-market losses that we would as with other sort of things that are in the trading book.
This is a true diehard question in the sense that it's very wonky. Nellie, I just looking at your paper, which I thought was great. The overall impression given by some of the data you had was that the stress tests were fairly countercyclical and had held up quite well over the economic cycle. But I was thinking that if you adjusted for the change in the treatment of balance sheets over that cycle, that it would make a difference, because at the beginning, back in 2014, 15, 16, the Federal Reserve was projecting increases over the stress period in bank balance sheets of over 15%. And that reflected the experience of the financial crisis, where over the first 3 years, there were increases in the bank's balance sheets. And now we're moving down to no increase in bank balance sheets. And I think if you incorporated that, you'd see that change, plus what you discussed with the change, the stopping pre-funding in certain areas, and other changes that are happening, we're getting pretty close to almost a pro-cyclical kind of move in the stress capital buffers. So I was wondering if anyone might have any comment on that.
So thank you for that question, Marcus. Fully agree that the risk-weighted asset assumptions have made a difference. We were just trying to, for our presentation today, simplify it down to two pieces. Risk-weighted assets were increasing earlier. They're now, by assumption, being held flat. So that would have added more, as you say. I think going forward, it's a reasonable assumption to be flat, though. It was a difficult added uncertainty that wasn't clear. It exceeded the benefits of a non-static balance sheet. So it's one of the trade-offs, though. It could certainly be put in, and yet one more lever to move to ensure cyclicality, or counter-cyclicality.
I'm going to start calling on people if we don't get enough questions.
Thank you. Steve Boris, Citizens Bank. If CCAR has in fact resulted in a contraction or restriction of credit availability in return for less risk in the system, in many ways it has broad implications beyond just the scope of stress testing and even the symposium. Has anyone considered taking all of this data and building effectively a Markowitz-efficient frontier? You could put systemic risk on the x-axis and credit availability on the y. And then you could have a debate, much like what we were just talking about, with availability of credit to certain sectors or certain asset classes, so C&I, CRE, affordable housing. And then, of course, somebody would want to figure out what is that tangency portfolio, what is the optimality. Now, it has broad policy implications. And when we were talking about transparency, because everybody's going to want to know about those models, it might turn this morning's food fight into a wrecked homecoming parade. But has anyone thought about doing such a study? It's kind of a geeky discussion. Sorry about that.
So you're raising some tough issues. So a couple of thoughts here. I think there's a view about historic rapid credit growth and the increased probability of a financial recession or a financial crisis. And so there's some move towards trying to understand what's the optimal amount of credit growth. Then there's credit growth, and then there's the composition of who holds it. And if it's the institutions whose failure would have large systemic externalities, then you're better off by sort of redistributing some of the credit provision. If it's so there's lots of dimensions, not just total credit, it's also distribution. I think people are thinking about it, but it's very difficult. So there's a lot of research that has happened over the last decade since the crisis about how bad too rapid credit growth can be. So it's after the fact we've started to understand some of the issues, and I think there's pretty compelling evidence that very rapid periods of growth, unsustainable, sort of to separate financial deepening from excessive credit growth, can be costly. It leads to a recession, and those recessions are more costly. So that's the piece that you have to make some assumptions about how long the recession would be, how deep the recession would be, and we're learning that they're actually quite much more costly than one would have thought. And so I think that's a goal of researchers and policymakers everywhere, but I don't think we're there yet.
And Nellie, I mean, I think it was my reading of your paper anyways that a lot of these studies have a little bit of a flavor that the affected institution changes its lending behavior, but perhaps the total amount of lending to that particular class of borrowers may not be affected because there's pickup from smaller institutions.
That's right. So the welfare of whether the less credit from the stressed institutions and more at the smaller institutions, that's something that to give some researchers.
Thank you.
Hi, I'm Joe Capone of Soros Fund Management, and I'm effectively a longtime investor in Bank, Global Bank and Financial Equities. One observation I and most of my colleagues have made over the years is that U.S. banking is one of the only industries where there are not demonstrable economies of scale. And in fact, there are some diseconomies where the largest banks, the CCAR banks currently, have often lower return on assets and certainly some lower return on equity than their smaller peers. And I think that's one of the reasons why there's so much pushback on stress testing broadly. But I had a theory I wanted to run by the panelists and see if this makes sense or not. As an investor, I've sort of thought that at some point, if stress testing actually worked, that the markets would eventually accord those that are subjected to the stress tests with a lower cost of capital and potentially a lower cost of funding in the debt markets. And while it may take a recession to sort of prove the value of stress testing in terms of an institution's ability to weather the storm or perhaps even profit or monetize it, I was just wondering if any of you think that that's something that could really occur at some point. And I think if that were the case, I think you'd see the big banks sort of embracing the process more than I see from my seat.
Yeah, maybe I'll tackle that first. You know, I certainly agree in theory, Joe, with what you argued. I'm just not sure if we've seen that in practice. Even if you look at narrower industries, the mortgage insurers before the crisis, there were some a couple of years earlier who had much higher credit ratings, and they didn't feel like they were getting rewarded by the market for that higher level of capitalization. And so I'm not convinced that you're going to see that reward unless we do go through a tough economic cycle and the big guys come through with flying colors. That might be enough to change opinions, but certainly not in advance of that.
I'm afraid here I have to sort of go back to some of my my old research activities, which actually were from before the crisis. Not an obvious one.
Just make one comment on the economies of scale. I think it's really interesting insight. Some of the research we reviewed for this paper, which was the effects of the stress test on credit provision, suggested that the stress test buffers and the losses, banks pulled back from markets where they didn't have branches. So they had sort of extended into areas where maybe they didn't really have efficiencies or sort of economies of scale or scope. And that was the first place they pulled back. And so what you saw was the credit provision shrinking in markets that they didn't have branches in. And you also saw the defaults rising in the markets where further distance from local branches were, you know, that was where they were highest. So I thought those were pretty interesting insights. It goes back to the business of banking in some sense of like, you know, is there private information between the lender and the borrower that banks can provide? And I don't know how much scale there is to that, but it's really interesting.
Okay. Well, going once, going twice. Bill, you want to wrap us up here? Thank you very much, everyone.
For the remaining diehards, on behalf of the board and the Federal Reserve Bank of Boston, I'd like to thank everyone for participating in this great day of discussion and debate. And in particular, let's give one more round of thanks to all of our presenters, moderators, and discussants. And just as a reminder for those of you who couldn't get enough, or for the people who missed it, all of the papers and the video of the conference are now available on the conference website. And everyone have a safe trip home.